What happens when the world's most powerful central bank gets a new leader? Today, we're diving into the new Fed chair's approach to America's economic challenges, and what Kevin Warsh's leadership could mean for the United States, the United Kingdom, Europe, and emerging markets like India. Let's get into it. Welcome to Funda-IQ, where we break down personal finance, economic trends, and financial markets into clear, actionable insights. Today, we're decoding one of the most pivotal central banking transitions in recent memory, and what it could mean for your savings, your investments, and global trade. A leadership change at the world's most influential central bank is never just a headline. It's a signal. Inflation is still running above target, growth is slowing, and global markets are watching every move. The decisions made in Washington will ripple outward, from London to Mumbai, shaping economies far beyond America's borders. As of April 2026, the U.S. economy is navigating a tricky stretch. Headline CPI climbed to 3.3% in March, driven largely by a 12.5% surge in energy prices. Core inflation sits at 2.6%, still above the Fed's 2% target. The federal funds rate holds steady at 3.50 to 3.75%, and unemployment has ticked up to 4.3%. The picture is one of persistent pressure with no easy off-ramp. The incoming Fed chair inherits a complex set of structural headwinds. Shifting tariff policies are disrupting supply chains and adding to inflation. Immigration policy changes are squeezing labor supply and pushing up wages. And AI-driven productivity is beginning to reshape entire industries, though its full economic impact is still unfolding. Together, these forces make traditional monetary policy tools harder to calibrate than ever before. Now let's turn to the man at the center of it all. President Trump has nominated Kevin Warsh to succeed Jerome Powell as Fed chair. Warsh is calling for a genuine regime change at the Federal Reserve. And he's not mincing words. His view? Inflation is a choice, and the Federal Reserve must own that responsibility. That's a bold opening statement for a new era of monetary policy.
Warsh wants to rethink how we measure inflation. Rather than relying solely on traditional core PCE, he favors trimmed mean indicators. Metrics that strip out extreme price swings to reveal a cleaner picture of underlying inflation trends. He's also proposing a real-time data project powered by artificial intelligence, designed to give policymakers sharper, faster economic insights and improve the quality of rate decisions.
On the balance sheet, Warsh is clear. Interest rate adjustments should come first. He views large-scale asset purchases as inequitable. And with the Fed's balance sheet still sitting at around $6.7 trillion, including $2 trillion in mortgage-backed securities, he sees room to normalize. His approach? Gradual, deliberate reduction. A scalpel, not a sledgehammer, to reduce market distortions without triggering unnecessary volatility. Warsh is a firm believer in keeping the Fed focused on its core mission: price stability and maximum employment. He's pushing back hard against the idea of expanding the Fed's mandate into areas like climate policy or economic inequality. In his view, mission creep doesn't just dilute accountability. It makes monetary policy less predictable, and that unpredictability has real costs for businesses and households alike. Central to Warsh's philosophy is Fed independence, decisions driven by data, not political pressure. He's also genuinely optimistic about AI's long-term potential to lift productivity, raise the economy's sustainable growth rate, and influence where the neutral interest rate ultimately settles. That said, he's realistic. The benefits won't show up overnight. There's a meaningful lag before AI gains translate into labor market outcomes. Warsh's agenda rests on 4 pillars: anchoring inflation expectations firmly, restoring policy predictability, strengthening the Fed's data-driven credibility, and adapting to the structural shifts reshaping the U.S. economy. Together, These priorities are designed to build a monetary policy framework that's not just reactive, but resilient. Now, the real question: how does this play out in practice? Investors and policymakers are watching closely. The implications for the U.S. economy will depend heavily on the sequencing of policy moves, the pace of change, and what the incoming data actually shows. Done well, this transition could be a genuine turning point. Done poorly, it carries real risks, and markets will price both scenarios in real time. For the U.S. domestic economy, the opportunities are meaningful. Stable inflation restores purchasing power and makes long-term planning easier. Greater policy predictability encourages investment. And AI-driven productivity gains could expand the economy's capacity over time. But the risks are real too: a softening labor market, higher borrowing costs, and the inevitable lag before AI productivity shows up in the data. The outcome hinges on execution, sequencing, and how structural forces evolve. U.S. monetary policy doesn't stop at America's borders. For the UK and Europe, the transmission channels are well established: dollar strength, financial conditions, and trade volumes. A stronger dollar pushes up import costs, adding inflationary pressure abroad. Tighter U.S. financial conditions ripple into currency markets and bond yields. And if U.S. demand softens, British and European exporters feel it directly. A headwind neither economy needs right now. The Bank of England and the European Central Bank set policy based on their own domestic data, but they can't ignore what's happening in Washington. A stronger dollar raises import costs. Tighter U.S. credit conditions increase the cost of business finance globally, and weaker U.S. demand hits export revenues. On the flip side, if Warsh delivers genuine policy predictability, it could actually stabilize global markets, giving the BOE and ECB more room to maneuver. Emerging markets are among the most exposed to shifts in U.S. interest rates and dollar strength. When the Fed tightens, the transmission mechanism kicks in fast, and history shows it can trigger significant volatility across emerging market asset classes. Currencies, bonds, equities, nothing is immune. Here's how it works. Higher U.S. rates push global yields up, making U.S. assets more attractive. Capital flows out of emerging markets, local currencies depreciate, import costs rise, and domestic financial conditions tighten all at once. The severity of the impact varies by country. Those with strong fundamentals, deep reserve buffers, and credible central banks tend to weather the storm better than those without. For India, the challenges are specific: higher oil import costs, rupee depreciation pressure, and equity market volatility driven by capital outflows. The Reserve Bank of India faces a delicate balancing act, managing currency stability while supporting growth and keeping inflation in check. But India isn't without defenses. A large domestic market, ongoing structural reforms, and substantial foreign exchange reserves provide meaningful buffers against these external headwinds.